Hello and welcome to the Two Ace Podcast, the podcast designed to help you manifest your Two Ace mindset. My name is Josh Brooks and my one focus is success through the art of discipline and flow. I hope you enjoy the episode. Now let's get right into it.
Hello, thank you for joining me today. The following episode is a little bit different to the usual episode because me and Steve will be talking more about finances and investments. And yes, these do link to mindset in the sense that in order to control your mind, in order to control your life and figure out how to achieve your goals, you must ensure that your finances are up to a certain standard, and that takes a lot of mental power, mental strength. And I'm going to be asking Steve a lot about how he not only invests his money and invests for other people, but how does he invest his time wisely to ensure that his mind and his life is fully optimised and he can take the most from each opportunity he is presented with. I hope you enjoy the episode. Let me know what you think. Message me on Instagram, comments down here, let me know. All the socials are on my page. Enjoy. Good morning, good evening, good afternoon, or whatever time of day it is you're joining me. I hope you're having a good one. And today I'm going to be talking with Steve Selengut. And yeah, how are you doing today, Steve? Just want to introduce yourself a little bit.
Yeah, I'm doing well, Josh. Good to be with you. I guess as a matter of introduction, I'm an investor. I've been an investor most of my life. Since I was 25, I started. I developed a system that generated a lot of income, much more than my employment income was. So eventually I could leave my job in New York City and start my own business of managing money and creating income for other people. I did that since I was about 34, so it's over 40 years that I did that. I managed roughly $110 million. I don't know what that is in pounds, but in dollars, it's a significant amount of money for about 135 different individuals and families in the United States primarily, some in other countries, not much. But I sold that business last year, and since then I've started a coaching business, and I've written a book. The book is Retirement Money Secrets, and you can probably see it over my shoulder there. And what it does, it defines a process where people can start really to become effective investors young in life, really. If they learn to put away their money in a safe place while they're starting out, so it's protected from the risks that can create a total loss on a hunch you took or a tip you listened to or something like that, because it's building your income all the time in a diversified portfolio of securities. And that's what I teach in the book: how to determine risk, how to diversify properly, how to make sure you're getting the income you deserve from things you own. And most of all, and it's something from our conversation, Josh, that you already know about, is you got to learn how to take profits when they're there.
Yeah.
You got to say, hey, my price just went up. I've got a target. My target's 6% or my target's 10%. Hit my target. I'm not going to wait for it to go higher. I'm going to take my target and I'm going to start over with something else. And that's the type of system or process that I talk about in the book, and it's what I teach to my coaching clients. So that's what I do.
Cool. Yeah, nice. Thanks for that. That's a really very detailed introduction to yourself, and I feel a lot more ready for this. So, on the topic of risk, how do you ensure? Because you mentioned diversifying your portfolio. How do you make sure you're not like spreading yourself too thin?
Spreading yourself too thin. That's that's an interesting way. People can diversify too much and spread themselves too thin, I suppose. But for me, I like to not have a lot of a big percent of any of my portfolio in any one security or type of securities. So I think classically, if you take an MBA in investing, they'll tell you that proper diversification is to have no more than 5% in any one thing. So if you're in the real estate, you'd have 5 different apartments at least, that are generating income. So, or if you were in the stock market, you'd have, for 5%, you have 20 different stocks in your portfolio. If I throw in a lot more. I want to have my personal portfolio. I have over 200 different things.
Oh, wow.
Different types of different securities, different sectors, different countries, different management teams. So I am so diversified that I've really taken it from a risk minimizing technique, which most people use, and I've turned it more into an offensive weapon. So what I'm saying, if let's say the European economy takes off and the U.S. economy doesn't, okay, I've got enough invested in the European community and other overseas countries that some of my funds will do well. I'll be able to take profits. The other ones may not do as well, but they'll still be paying me the income that I purchased them for. So I have 2 streams of income going on. I have, just like in real estate, I have rents. My rents are in the form of distributions from these closed-end funds I use. And my second stream of income is trading those funds, just like you would trade currencies, just like you would trade whatever. Anybody, just like a department store trades the stuff on its shelves. It's the same principle. You buy something. It's capitalism, Pete. For Pete's sake, I mean, you buy something, you put a markup on it, and you sell it. You do it over and over again. McDonald's does it with burgers. There's not a whole lot of difference between burgers, but when you sell 170 gazillion burgers, you make a lot of money. Yeah. So I feel the same way about the securities I own. They're all different, but they're all the same. When I can make a profit, I take it and I add back one of the ones I may have sold a month ago.
Yeah. Well, you just mentioned McDonald's right there. That's a lot of people think they're in the food industry, right? But they're actually in the real estate industry.
That too, yeah, and you're right, because these are franchise things that they have, and they're collecting, and yeah, that's right.
So, how do you pick which stock or which commodity or which security to?
I think
invest
the first. Okay, so we talked a little bit about diversification, which is what I feel one of the pillars of risk minimization. If you're diversified and something happens, you're not going to get knocked out of the game entirely. It'll be painful if something goes to zero, but not as painful if it was a big hunk of your portfolio. But the most important feature of any investment is coming up with a way to determine the quality of the investment. How do you do that? In individual companies, I look at how long they've been in business. Are they profitable? Do they have a lot of things in the game? Are they, if they're a pharmaceutical company, do they have more than one drug? And do they do other stuff? In any industry, you'll find that most companies have diversified, so they have different pieces of action going on. But that's part of the quality of that company. There's more than one thing going on. Some people can say they check out the management. I don't know how I'm qualified to check out any other manager's abilities. You know what I mean? I look at results. Are they profitable? Have they always been profitable? Most importantly, do they pay dividends to their shareholders? I mean, sure, they pay their chief executive $5 million a year, but if they don't pay any dividends to me and I own a piece of the company, that's not right. Shareholders deserve more than what most companies provide, because they're the ones that they're 100% at risk. So I'm looking at all those things. I'm looking, and for me, since I'm a trader, since I have these two streams of income, I'm looking at the income, direct dividend income, and then trading. I want to see volatility. You know how when people talk about the markets, they always are crying about how volatile it is. It's terrible. I think it's wonderful
Yeah,
because
I agree.
I can buy the same thing over and over and over again and sell it over and over. You know, so that's that to me in a closed-end fund, which is what I use, and we can talk about what they are. It's a different type of investment vehicle. Um, I look for the volatility as part of the element of quality that I need to run my portfolio.
Got you. Am I right in saying that you're more analysing the fundamentals and sentiment rather than like the actual technical basis of it?
Absolutely. I've
Got
been
you.
fundamentals forever. I mean, technical analysis is very, very popular, and I'm sure a lot of people think they're getting some idea of what the future is going to bring by studying all these technical thoughts. But then when something big happens, you have COVID, and all of a sudden it throws all that technical analysis right out the window. But fundamentals still remain. The companies that are solid companies are going to make it through a pandemic. They're going to come up with ideas so that they can still have their employees working, they can take care of them, they can take care of business, and they'll come back to life. But the stock market might take a little while to do that, still. So
Yeah. Well,
I'm more of a fundamental. I'm more fundamentals, conservative fundamentals than
got you.
for sure.
Yeah, because I can see I do. Actually, I trade, and I see fundamentals and sentiment analysis as definitely a thing to consider. But I'm more of a technical analyzer because I do micro trades. So I day trade, and I feel like. Have you heard of something called ICT concepts? It's like an algorithmic price action theory.
No, I haven't.
I thought you might. I can sort of, yeah. I feel like you don't. I feel like the way you trade, you probably wouldn't consider that as even viable, right?
No, but I don't know. I grew up with the fundamentals. I grew up with that. I've made a lot of money with that. And so, when it ain't broke, you don't fix it.
Yeah,
so
exactly.
I'm sure that there's a lot of different technical analysis out there that works. And even if it doesn't predict, it comes close. It recognizes trends and it capitalizes on that knowledge. I do the same thing with what I call market cycle investment management. A market cycle is not totally predictable, but it's recognizable. Like right now, if you look at the New York Stock Exchange, well, don't look at it today because it's down a bunch. But yesterday, the Dow was at an all-time high.
Yeah.
So, and
it was bank holiday yesterday, wasn't it?
Yeah, but the last trading day was today. No, it's open today. Yesterday it was closed.
Yeah.
Okay, so last Friday it was at an all-time high. Today it's down from there. But the point, you can't interrupt old men when they're talking, because we lose our train of thought.
Sorry.
So I have no idea what I say. But yeah, I'm sure there are technical analysis. But I grew up, like I said, with fundamentals. So I'm looking at these quality elements because I want to be certain that it's going to continue to pay me a dividend. And I want to have the hope that it's going to go up enough in price for me to sell it and take a profit, and to do that over and over. So yeah, the technical analysis is good if you're looking for longer term profits down the road, and for really short term profits if you want to trade on a day trading basis. If I trade, I'd be happy to take a nice profit in the same day if I get the opportunity, but I don't expect it to happen. So what I'm buying, I'm not getting rid of the same day. I'm keeping it until my profit is achieved, and then I'm selling it.
Yes, because with the reason why I mentioned and brought up technical analysis is because it's based on liquidities, which is similar to the market cycle in a sense, because there's like internal, external liquidity, and that's how you manage your targets and your stop loss placement. So,
Okay.
in the fundamental aspect, how would you manage your risk?
Okay.
Do you use a stop loss at all, or do you just sort of buy and hold?
Well, I never buy and hold, and I don't use stop losses. What I use is targets, and using the market cycle. I know, for example, I can look at a chart and see if the overall market is high. You can look at advanced decline indices. That's a technical analysis tool. If more things are achieving new highs to new lows, you know you're at the upper areas of a market cycle. So when you buy equities at that time, I don't buy as much of them. I buy like a third of what I normally would, because I know there's a likelihood it'll go down. And if it goes down 5-10%, I'll add to my position, and I'll continue to add to it. But because I've achieved, I have the ability of determining the overall quality of these companies. I can trust Exxon if it goes down in price, IBM, Microsoft, whatever the big quality companies are. I don't expect them to go out of business just because we have an economic recession or something like that. Whereas with a new company, one of the new tech companies just came out, and all of a sudden COVID hits. How many brand new companies do you think went under during COVID because they didn't have the wealth to survive that type of a change in the environment. So I do the quality thing. Quality is number one. Diversification is another way of reducing risk. Income production reduces risk because the companies and whoever you're counting on to pay the income it's got to be in a profitable position themselves to give you that income. And profit taking. Profit taking is one risk minimizer that most people don't appreciate, because they don't understand the cyclical nature of both the market and interest rates. When those things go down, if you just look at market value, you're going to lose market value. Your growing market value doesn't put any more money in your pocket, not until you sell it. It doesn't increase your income, not until you sell it and reinvest it. So those are the parameters, that I'm using. So once I've determined that these 250 closed-end funds that I use have met all these judgmental quality parameters I've set up, then I trust them enough that if they go down in price, I see it as an opportunity to add to them. If they go up in price, I sell them, I make a note of which ones I've sold, and then later on, a month later, 3 weeks later, whatever, as I generate more and more income, I'll go back and I'll buy them again. And I'll just do that. It's boring as hell, right? I'm using the same companies. I'm not doing anything special. I'm just buying them, collecting distributions until I can take the profits, and then I start it all over again, one at a time.
Okay. Did you do it as a monthly basis? You do it quarterly?
No, I do it every day. Today I've sold 9 different things for profits, and so far today I bought 15 different securities to add back to my position into my portfolio, and I got another 10 on my list that I'm going to buy after we get off this call.
Great. Okay.
And I do that pretty much every day. So it's a very active trading type thing. It's usually done by this time of day, and then if the market really, really goes up, I'll look and see if I have any more profits to take. But otherwise, I'll just wait until after the market closes, and I'll go through and I'll look and decide what I'm going to sell tomorrow and what I'm going to buy tomorrow.
All right. So
at the end of the day.
How do you define the market cycles though? Because you mentioned that. How do you define that?
Well, like I said, for example, right now there are things called income purpose securities that are designed to give you income, bonds, preferred stocks, loans, mortgages, REITs, BDCs, and a few others. These are all combined in these closed-end funds that I have. And closed-end funds are older than either ETFs or mutual funds. They've been around since the early 1800s. They were actually developed in Europe, I believe, before the time of mutual funds. So, but they're trusts. And I don't know if you're familiar with a trust document. It's what old people like me set up for their kids, so that when they inherit, it goes into a trust, and a trustee manages the money for them and pays it out to them, the income. Well, these are the same thing. They're trusts. All their income has to be divvied up among their shareholders, unlike corporates where they pay out what they want to the shareholders. These guys have to pay out 95% of their earnings. Okay. So you can't expect them to grow in market value a lot because they're not reinvesting everything like a Microsoft is or an Amazon or so on. But they produce enormous amounts of income, and that's why I have them, in my portfolios. So.
Got you. So you've been doing this for 40 years. You must have made some mistakes in that time.
I've made some mistakes. I've never made the mistakes of not taking profits and seeing them disappear. I've made the mistakes like not recognizing closed-end funds sooner and how much they would have helped long-term in my income development. One thing that, you never stop learning. I mean, I sold my company. I was 78 when I sold the company. And when I was writing the book, it was a combined effort. Guys in my Facebook group and ladies in my Facebook group, we did Q&As and things like that, and we actually outlined what the book should be like and stuff like this. And these two guys were telling me how they did some of their profit taking. And what they would do is, in an operation like mine, you buy it, and then if it goes down, you buy more of it, and then more again. And you might do this in a correction. You might do that 4 or 5 times. But on the way up, I used to always wait until the whole position became profitable before I'd sell it. But what these guys were doing, on the way up, the one that they had bought most recently could be up 5%, 10% even, while the rest of it while the total position was still down. After a major correction, you're buying and then coming back up. So what they would do is they would selectively sell those profitable positions and then reinvest them either in something new or something that hadn't gotten back on track yet, and do it again and again and again. I started to do that after we talked about that, and I put it in the book. We call it the accelerator principle, And this year, for example, so far through the end of August, I've made the equivalent of 5 additional months of income by trading that way.
Nice.
I mean, just like you trade every day, this is very similar because you're trading a piece of an old position. You may have had this position for years, but that most recent lot that you bought is at a profit position. You take it, and just doing that. I mean, I haven't taken too many profits, more than 5% this year, but I've made that much money just trading lots as each time the cycle goes up and down, or the individual cycle within sectors. And so it's just magical how much the profit taking has increased. And if I had known about that earlier, wow. So I guess those are the mistakes or things I just didn't think of on the way,
Yeah. So you said that taking profits has been probably your most strong aspect of how you trade, right?
Oh, absolutely.
Yeah, that's good.
Absolutely.
You're always wanting to secure that, a guarantee almost, and not leave any more risk on the table. If you see money, why would you not take it? So I know some
Yeah.
people, and I've been victim to it myself. Of you see, well, in the past, not so much recently, but you see like a level that's succeeded, and you see the you're up a certain percent, and you're like, oh no, but it'll go up here. And it doesn't, so you hold it and it goes down, and
and that's what all the experts are telling you. Oh, this is a $40 stock. It's only at 30.
Yeah.
You want to hold on. You want to hold on, and that's what they do, and that can kill you when the market decides to go down. So I try not to let that happen. I learned that really a long time ago, and I started out. I just always when I thought about it, I said, what has really made the price of shale oil worth $10 more a share than it was 3 weeks ago? What could have made that happen? How is that logical? And I said, it's really not logical. It's all speculation. People are doing it. Something's going on. They might have heard a bit of news. There might have been this or that. But and I look at the chart and it's like this. And I'm saying, I'm going to, every time it goes up 10%, I'm taking it. I'm not going to worry about why. But if I keep making little 10% profits, I'll be all right. And, within 9 years, I started investing when I was 25. 9 years later, I was quitting my job and making significantly, almost four or five times more than I was making in New York. And I started my own business. I can do this for other people. I'll just show them what I've done with my portfolio. Here's where I started. Here I am now. I'll do this for you. It wasn't hard getting my first 2 or 3 clients, but then after that, you had to, went for real strangers. These were friends, but strangers, you had to show a longer track record. So over the years, but it worked well. So.
Yeah. So how do you find it different in the different quarters of the year?
Not really. I mean, my technique is such that I'd say October has always been, in my experience, has been the month where the market most often goes down. I used to think that November was particularly interesting because people would, accountants and advisors tell people to take losses so they can apply them against their taxes. So they'll take $10,000 in losses so they can pay $3,000 less in taxes. That never made sense to me, but people do that. I used to call it the November syndrome. So I'd go in and I'd look what good companies got really low in price in November, and I used to buy them in November, and I'd be selling them in January because they'd all go back up again. But yeah. I don't know. I developed a lot of different little tricks to the trade. There are these closed-end funds. Some of them will not pay a high level of dividend during the year distributions, but in December they'll pay out a huge dividend, like 10 times their normal dividend once a year. So I'd start to buy them in September, and then when they announced the dividend, I wouldn't hold on to actually get the dividend, because as soon as the dividend comes out, it goes right back down again in price, right? So I'd wait until like a week or so before the dividend was paid, and I'd take my profit then, so I didn't have to keep this thing that was paying almost nothing for most of the year, and I just, collect it in the form of a profit, and I wouldn't have to hold it like that, and I put it back to work. So there's different tricks you do with different ones as you work on these things. There's something, like, I'm sure when you're trading, you have sort of some special things you do that almost always make money for you.
Yeah.
It's the same with these closed-end funds. I feel comfortable buying almost any one of them. I think I've sold over 200 different closed-end funds at least once this year already. Not big profits, mind you, but these little profits just add up and add up, and eventually it turns out to be maybe a third more of the income than you expected to gain this year just from profits. So
how different is your approach to trading, to stocks, to the market, to your work, I guess, to when you were my age, to when you were a lot younger?
When I managed, the only thing that's different is that that trimming of profits on the way up that I described to you. But I've always, for my clients, I always took stock market profits. I always took them at 10%. Never went beyond that, and always reinvested it. Everything I owned always paid a dividend. I wouldn't buy any stocks that didn't pay a dividend, or do IPOs or things like that. Everything had to have a track record. So that hasn't changed. The closed-end funds really are, they own exactly the same companies I used to trade when I was trading stocks. When you buy a closed-end fund, typically you're buying a couple hundred stocks in there. And all those heroes, like, let's talk about Berkshire Hathaway is one of the most popular stocks that you'll find in model portfolios and things that advisors recommend. And it should be, but it's like $1,000 a share. So who can go out and buy 100 shares of that? Not too many people, right? So if you buy closed-end funds, you're getting some of that. You're getting some of the Microsoft, some of the Nvidia, whatever the hot stocks are. That manager has some of them in his portfolio. So you're not missing anything. You're just taking a more conservative approach to get to it, and one that generates enough income that when your kids get to be college age, you'll have enough to pay for it. That type of thing.
Yeah, so just for sort of clarification for the audience, would you mind explaining the difference between like these closed-end funds,
Sure.
exchange-traded funds, things like that? Because I'm aware of the lingo you're talking about, but I'd assume a lot of the listeners here might not be aware.
Okay. Closed-end funds are trusts. They're trust vehicles where the managers use the money they raise with an IPO by when they bring the stock public, stock in the trust, they raise that money and they invest all that money in securities. They buy stocks, they buy bonds, they buy real estate investment trusts, whatever. As trusts, they have to pass through 95% of the earnings to their shareholders. So consequently, it's pretty impossible to make that type of security grow in market value because they're not reinvesting much of their earnings. So it's primarily and solely an income specialized market instrument. You've got the same investments that you would have in mutual funds or ETFs, but the focus is to give all the earnings back to the shareholders. Mutual funds and ETFs, prices of the funds themselves are brought into balance with the net asset value of the assets every evening, so they trade at net asset value. Closed-end funds are more like ordinary stocks, where they don't have what they trade at is purely supply and demand for the shares, has nothing to do with the intrinsic value of the company you're buying, just like a stock on the stock exchange. Mutual funds are not available really during a trading day. They get repriced, and if you order one today, you get tomorrow's opening price. Both of them add or delete shares from the market so that the price matches their net asset value. And none of them, or I shouldn't say none, very few of them focus on generating income. They're mostly interested in growing market value. So the average yield on mutual funds and ETFs is probably somewhere below 3%, whereas the 250 different closed-end funds that I use that meet my quality requirements are yielding right now around 9 to 10%, and even the tax-free variety of bonds in the United States, tax-free, are yielding over 6%. So there's really no comparison in the income side of what they're doing. They vary in price. Um, they're as much affected by changes in interest rates as they are by changes in the stock market. Even the ones with equities inside are still interest sensitive because they pay so much in the dividends. They pay around 9% right now. So they're going to vary with interest rate expectations as well as which way the stock market's going. So those are the distinctions between the two types of securities.
So do you just trade those two types?
I only trade. I do for some of my wealthier customers, my wealthier coaching clients. I can provide them with 20 or so ETFs that are paying an average of over 10% that I use for myself. And I don't own any individual stocks anymore. I haven't owned an individual stock since about a year after the financial crisis back in '08, because the rally was so high that they never went down to a place I felt comfortable buying them. So I stopped buying the individual stocks and started buying the closed-end funds instead.
That's smart decision. I on the note of sort of risk management in terms of like being comfortable with it, do you always set out do you have certain rules for your risk for each investment, for each client, for each sort of for each investment, I guess?
Yeah, I've always had, you always knew what the client's risk tolerance was, but I never really owned anything that was really that risky. Even in individual stocks, they were always dividend payers, profitable companies, etc. All those elements of safety were there. But in advising people, I find that even when I look at people who have now have managed portfolios, and I look at the risk elements that I apply against portfolios for my clients, I'll see lots of them with 20% or more in one single security of their overall portfolio. I'll see them where they have 100% profit or more in a security. They've owned it so long. A long-term profit. Our tax code treats long-term profits more favorably than regular income. So, but those are the most things. I don't see. Diversification is either none at all, or it's in a model portfolio, and they'll have fractional shares, like 3.756 shares of a company. How are they ever going to make any money on that? Even if it goes up 100%, what are they going to make? So it's just I see a lot of things that I don't agree with when I get to these, when I look at other portfolios. But that's, the quality is usually pretty good on managed portfolios, but there's those other issues, and most of them, almost without exception, generate less than 3% in income. And I'm looking at people who are talking about retiring. People in their 60s who are saying, "Hey, I'm looking to retire and take a look at my portfolio. What should I be doing?" And I say, "Well, you got $3 million and it's paying you 2% income. It's 60,000 a year or something like that, when it could be paying you $300,000 a year." It just doesn't make sense to do it your way, to do it that way. So we set up a plan to get them into a more income-focused investing.
Got you. So you mentioned that a lot of what you do, there isn't really much risk involved. How can you define something as like safe to do?
Well, it's safer. You can't eliminate risk. The market is the market is the market, and stuff happens. You got wars, you got terrorist activity, you've got, well, look at what's going on in Eastern Europe right now. Stuff happens, and you cannot eliminate risk. And the things I mentioned before, the quality of the companies you invest in, how well diversified they are, how much income they produce, those are the three key elements. You can't say, well, I'm going to buy this one anyway, even doesn't pay a dividend. I like it. You can't let your emotions get involved. Your emotions in not just in investing, but in a lot of aspects of life, your emotions and how you bring them to the question can get you either in good shape or it can cause you problems. You don't want to form emotional attachments to your investments, any of them. Don't fall in love. That's a big risk area right there. That's where I find people at, particularly company stock, in the company they've worked for all their lives and they're retiring from it, and I've got this 7,000 shares of Ford here, and I love my company, and I said, yeah, but it's paying you less than 2% income, so you're going to be selling some Ford every month to pay your bills. Instead, we sell it all, and we invest it at 10%, then you don't have to sell anything to pay your bills. So, it's that you got to change the mindset. Like as you get older and you experience some bad trades as well as the good ones, and you want to get rid of the bad, you want to get rid of the idea that there may be bad trades. Like I go through life not thinking there's going to be any losses.
Yeah.
I don't have to lose money on something. It may be down in price, but if it's still paying me 6%, that's great. I'll wait. I don't need to sell it. It's not in danger of going out of business. It's just it may have cut its dividend once, but it's still paying over 6%. I look when the market's at an all-time high. I look at my closed-end funds that are invested in the stock market, and I go all the way back to the one I bought back in the financial crisis that I bought that many years ago, and it's never gotten back to what I paid for it. And I compare with how much it's paying me in distributions and how much it cost me. Is it still paying me more than 6%? And if it is, I'm not selling it. And I haven't had to sell a security. I can't remember the last time I sold one because it no longer was paying enough. I can't remember when.
Okay.
Certainly none this year. Not one sale, not one loss this year.
Nice. That's good track record. So you're selling yourself there as well, aren't you?
Huh?
That's good.
Yeah, I mean, it's not because they're
rate.
not down. It's not because nothing is down in price. It's just because even though they're down in price, they're still paying me more than 6%, and that's okay.
Yeah.
So I don't feel the need to sell them.
Yeah, I've noticed since I've started thinking more in percent rather than like the monetary value, it sort of nullifies a lot of emotion in trading. And so because I'd assume that it comes with experience, and you can fortify your mind through that experience and through enduring the hard times and the good times. And like you say, you approach it with an abundant mindset. There's not going to be a loss. So what? But how's that changed since you were 25, since you first started out?
When I was doing individual stocks, I would, if a stock of the quality that I was looking at got down below 10 bucks a share, I would sell it. I would set a lower limit because I was looking. That would mean it probably went down almost 40 or 50% from what I paid for it if it got to 10 bucks. If it significantly cut its dividend, I got rid of it, because no major company wants the bad press that goes with cutting its dividend. So you know something's really got to be a problem there, right? If it says, that it's going to cut its dividend. Even at the worst of times, I don't know. Boeing has had an awful lot of pressure on it lately. I don't know, but I don't know if it's cut its dividend or not. But I know it would be the last thing that it would want to do, because that would really tank it. So, yeah, I always had I was at such a high quality level that if something really got any of those markers went off or say, whoa, that's not good, I'd get rid of it right away. I'd take the product. I would take the loss in those days. But once I switched to closed-end funds, now you're talking about, you're owning an average of a couple hundred, maybe close to 200 securities in every equity one you own, and maybe an average of 300 or 400 different bonds in every income one you own. If one of them goes under, I mean, it's like a zit. I mean, it's nothing. Really, you just not a big deal. That's how I feel so comfortable. Like I never lost sleep managing, like I said, 110 million for other people. I was never worried about them losing money.
Yeah, that's a good reassurance right there.
Yeah.
How is so? Do you think there's anything in today's sort of climate of how the technology industry is going, or how the markets are currently? Is there anything that you would expect would that I should keep my eyes on? For example, in my lifetime, I'm at the very start of my path, I guess you could say. So from now until, 40 odd years down the line, do you think there's anything that's going to be
wow,
that's going to absolutely take off, or maybe that hasn't even come to light yet that could potentially?
I'd say, geez, I believe that there are. I mean, think about where I was when I was 1970. I started investing. 1970. I was 25. There was no internet. No internet at all. There were no.
Just pick up the phone and do it.
You had to pick up the phone, call a guy. He'd write down a ticket for every trade. He'd have to write out a piece of paper, and then he'd take a few. He'd wave to his assistant. The assistant would come up and pick these pieces of paper up, take them to a wire operator. Then he would type them into a machine to take it to wherever in New York it was that they would actually place the trades. I mean, it was crazy. It took so long to get anything done. So there was no technology. I didn't have a computer. Everything was on the phone. All the records were paper. So it was such a different experience. As it got more and more updated, I just, by myself, on my accounts this morning, like I said, I just put in 30 odd trades myself before this conversation, just by saying, here, I want to do it this way. I'm buying this many shares. This is my day limit price, or I'm selling this tranche or this piece of this portfolio or of this holding. I know I've got 1,500 shares, but I'm only selling this 900 shares. And I did that, all by myself without calling anybody. Just bing, bing, and it was done.
Yeah.
Just like that. So what's going to be down the line? I think AI, so far in my experience, is, they can't even correct some of my spelling errors when I try to type, because I'm not a real typist and I make a lot of mistakes. And so I don't know. I think AI has a long way to go. I think it'll be a long time before I trust the management of my portfolio to a machine. I like to be able to look a human being in the eye, and say, what are you doing? with my money, that type of thing. If I was a client of mine, I'd want to be able to contact me by the phone and say, what happened with this or that. I'm still that old-fashioned. Yeah. For you guys, geez, I don't know what's coming. I would say that, keep an open mind. There's going to be a lot of changes, and hopefully they'll all be for the better. Maybe someday the investment community will start thinking about how they can grow your income for you instead of how they can grow their own income by pushing your market value higher.
Okay.
Because market value, the cover of the book you saw, market value fuels the ego, income fuels the yacht. That's the way it really is. You've got to have income. And at your age, if you start developing income now, and you can invest it at 10%, like let's say you take some profits trading, put in some of those closed-end funds that are yielding 9 or 10%, and when you see that income growing and growing and growing year after year, by the time you're my age, you can do whatever you please. That's the way I feel now. If my wife says to me, "Hey, you want to rent a place down in the Keys for a month this winter?" I don't even have to blink my eye and say, "Sure, go ahead." That's where you want to be. That's where
that's the dream. That's the plan.
That's the plan. And how old are you?
21.
21. Okay. You're the same age as my granddaughter.
Yeah.
She's just graduating college this year. So that's what I've always said to her too. I said, start investing, invest, and get that money, cash flow coming in, and grow it safely. And even if you produce it, like you're producing it in a trading environment, just put a little bit of it away.
Yeah.
Doesn't have to be a lot. And eventually, it takes care of itself. You'll be making. I remember people who used to invest in IRAs. We started with IRAs in the United States. You could put in $1,500 a year, and now I think you can put in $7,000 or $8,000 a year. But I used to, for my IRA clients, I used to try to tell them, I'm going to make you more each year than your contribution is going to be. And we're going to grow. We're going to grow this thing, so it's going to really mean something. I just wish they had those. They now have those Roth IRAs in the U.S. And those are tax-free. I just wish they were a little earlier.
I was looking into them earlier, and when I found out that the UK can't access them, I was a bit gutted, to be fair.
Yeah. But in the UK you got a lot of other benefits though, as far as education and healthcare and stuff like that. And we're backwards. We're really backwards when it comes to that.
Well, how
Education.
so?
Education is hugely expensive. Most young adults are strapped with student loans that could kill them.
Yeah.
I have had clients who come to me for coaching, and they're in their 40s and 50s. They haven't repaid their student loans yet.
Oh well.
I mean, wow. I was fortunate because I could help my kids and grandkids not have any debt, and I didn't have any. But there's so much of it, and healthcare costs here, just crazy. Even once you're on Medicare, like I am, old age benefits basically. It's still we still have insurance premiums. Our insurance premiums were like $600 or $700 a month, and we're on Medicare. So what is it? So we've got a lot to learn, and we're too stubborn we're too stubborn, and in our country to we don't understand that the more money you have in the hands of the employees of the workforce, the better that is for your corporation and its earnings, because those people are going to spend that money. Giving your money to your chief executive in the second, third, or fifth million that you give them, that's not helping the economy at all. And our tax code is screwed up in the United States too. But let's not get into all that.
Yeah. So Sort of wrapping it back into sort of the topic of the direction of this call, I guess. Sort of, how would you?
That we have to talk about. Okay.
Yeah.
Go
Well.
ahead.
Yeah. I feel like we'd be here for hours otherwise. Not that that's a bad thing, but anyway. You mentioned how you've experienced people with basically crippling student debt. How would you? And obviously that takes a toll on the mind as well as the bank account. How would you deal with that in terms of?
Well, I think it's something that has to be altered in the political mindset of the country. I don't think I can do anything about it. It depends. When you have debt, it depends on what the interest rate is, on how quickly you want to get rid of it. When interest rates got down towards zero a couple years ago, I took a homeowner's equity loan. I could borrow $100,000 at 2% or 3%, and I can invest it at 7, 8, or 9%. It's just like a business. Just like it's my business. My portfolio is my business. I could make more money doing it that way. And when interest rates went back up, I made sure I got out of it so that I wasn't still doing it. But if somebody offered me money right now at 3.5% or 4%, I'd take it, because I know I have the wherewithal to pay it back if something goes bad, But when you're looking at your student debt, if your student debt is 6 and 7%, that's killing you. That's killing you. And you have to start paying it off. So I don't have any solutions for it. I hate the idea that it happens, but I'm not running for office.
Yeah.
I can't do anything about it.
So, how did you actually view money itself, and how does that compare to when you were younger?
My environment was always one that was focused on money. My father was a real estate developer, and he had rental properties. He had properties he would sell. He had properties he would renovate and sell. He, was a developer, and do you know the term vertical integration?
I've heard of it.
Vertical integration, you own every aspect of your business. He owned the lumber yard that his suppliers would use. He'd make money on that. He would take back the mortgages and collect the interest from the people he sold houses to. He'd have the rental properties bringing in the rent, and finally he had an insurance operation that would sell them homeowners and automobile insurance as well.
Wow.
So he had all one contact, one connection. Hey, I like living out here on the lake. Sell me a piece of property. That went from property to building the house to renting it when they weren't there to insuring them, on and on and on.
Wow.
So he was an income-focused guy, and so I became that person myself. So I've always had that same mindset, and I think it's an important one to get. That the financial community is focused on market value, and they and their sense of fiduciary responsibility is growing your market value, which just coincidentally is how they get paid, on your market value. They don't get paid anything for making you income.
Got you.
So,
do you think that managing people's money has helped you sort of in day-to-day life, managing personal risks in day-to-day habits?
Well, I took it from my own experience. I was running my own money for almost 10 years before I started running other people's. And I was running my money the entire time I was running other people's. So, in fact, I used to tell them, I will never buy anything for you that I don't own. Okay? If there's a stock that I own, I'll buy it for you. If I don't own it, I'm not going to put you in it. It was that simple. So they trusted that I wasn't going to do anything, for them that I wasn't doing at the very same time for myself. I'd show them when they came into my office to interview me. I'd show them my portfolios. I couldn't do it online in those days, basically.
Yeah. Fair.
So, but yeah, I think what I did grew the business because it was working, and they saw how I lived. So.
Got you.
Yeah.
So by that I'm taking that it has. You've improved day-to-day risks by managing money, right?
I've reduced day-to-day risks.
Yeah. Well. Yeah.
Yeah. I think I identify risks pretty well. So I've never been tempted. Like I said, I never bought a stock that didn't pay a dividend. I never bought a mutual fund.
Nice.
Because I thought they were really managed by the mob. I mean, if people panic and they sell their mutual funds, the mutual fund manager has to sell the shares. That's how he pays them people back. Same with an ETF. They got to give them their money back. In closed-end funds, when they panic, they're just selling the shares. And the manager doesn't have to sell any. They're, you and I are buying and selling the shares. The manager is just managing the money. So nothing's happening to those shares. They're not getting sold. So it's a whole different way of running the money. Yeah.
Right. Okay. So, when you were first starting off, how did you actually build sustainability? Like, have you always had this?
I was one of the lucky
vision in mind.
I got that vision again from my dad's business. That I wanted to generate a lot of money, and I found that it was a lot easier for me to do it investing than it was working for that company I was working with. I didn't do all that great in college or anything. I didn't get a great job out of college. But it was good enough because I got into the pension investment department of that insurance company, and that taught me a lot about investing. So, but I didn't have any of the student debt. I didn't have any of the problems that a lot of young people have today. I was very fortunate.
Okay. We've talked a lot about investing money here, and just a thought came to me. How do you consider investing time? How do you invest your time wisely?
I've been genetically predisposed to be a workaholic. I mean, my father worked every day of his life until he was 89. I mean, I work every day. I'm in the office usually 7-ish, between 7 and 7:30, and I don't get out of here until 5. And I've done that every day. It doesn't bother me. I spend the time. I'm always doing something. If I'm not writing something, I'm doing something else, thinking about what I can do next. I've been a workaholic all my life, and I think that's a good habit to get into. I know people who say, "Well, it's 5 o'clock. I'm going home." If it's 5 o'clock and I still have stuff to do, I do it. It's like that.
Got you. So just to wrap things up with a positive note and how we can sort of give the audience a call to action. Number one, what's your definition of success if you could write it on a bumper sticker?
I don't know. I think creativity.
I love that.
Think about how to make things a bit better, or how it could be different. Don't just take for granted what they're jamming down your throat. And that's how I felt in the financial community all the time. I mean, you go online and you look at a mutual fund, it'll be very difficult for you to find how much the yield is. What is the percentage yield on this one? They'll show you its rate of return. They'll show you all of that stuff, but how much is it paying me? That's, I always, be creative. Think about stuff. Don't always take for granted that it's great news always that the market's up and bad news that it's down. It's just the market. It's always going to be one or the other, and neither one of them's good or bad. They just are. And you got to build yourself a platform that lets you take advantage of both. You want to be able to know what to buy when the market's down, and you need to sell when the market's up. So, you got to focus on what you're making on this that you could spend if you wanted to. You don't have to spend it, but if you don't have anything to spend, so if it's paying you 8%, you don't have to go out and spend the 8%. You can reinvest it, and then the next year around it'll pay you more than 8%. But you got to have that ability to make that decision with your money. And the only way you can do that is by investing for income and growing your portfolio by reinvesting that income, not by just watching a price of something go up to a certain, go up forever and never even pay you a dividend. Microsoft didn't pay a dividend for 30 years. So I don't know. I think that's the thing. You have to be creative and make yourself let that creativity lead you into something you really love to do. And
I really like that. Thank you for that. And then number 2 to end it on. So the majority of the listeners are sort of my age. We've talked about managing risk in a life filled with opportunity. We've talked about money management. We've talked about risk management and time management. If you could give someone a call to action, something that when they have listened to this episode, something for them to actually do, is there anything that you would say that?
Other than to read my book. What to do? I would make sure, and if they're still in the educational part of their development, get some education in finance. If you're not, if you've already in a career, get some education in finance. Whatever you do, you have to do that because you need to understand whoever you select to do your investing for you, and most people will have a professional take care of it. You got to understand what he's doing. Because I got to tell you, if you ask any of your financial professionals if they understand or know of what's put in that book or what we've spoken about today, most of them will give you a blank stare. They won't be familiar with the concepts that we've talked about. So get yourself some financial education and start with Retirement Money Secrets. And there's probably another dozen books you should read.
Yeah, that's a good place to start for sure. I'm going to be starting reading that. And I would recommend everyone else start as well. Why not? You've been very valuable to me and to the community today.
I mean, that's like for $10. That ebook, for $10, you learn a lot.
Yeah. Well, thank you for that, and thank you for joining me today, Steve. It's been great.
Okay, it was good talking to you too. It gives me, what can I say, more confidence in the future of the world when a young man like you and I can talk together one-to-one like this. I think that's a great thing. With 50 years,